Technical analysis, the most misunderstood topic of financial intelligence, the amorphous, much less sexy cousin of fundamental analytics. I'm going to give you what I wish I had when I started in the field. I'm going to give you a clean perspective from somebody who's not trying to sell you a technical analysis course. I'm going to tell you straight what technical analysis is good for and what it's completely useless for. There's no way that technical analysis is just a completely unfounded, unscientific field. There's tons of evidence that markets do move according to some specific patterns, whose signals you can extract from the data, and you can correlate with, to engage in predictive bets. There is no way around it. There are many examples of funds that have made a fortune on predicting these market behaviors, these herd patterns. There is just overwhelming evidence that the way that people react to the ebbs and flows of stocks can be predicted in some way by the signal that's coming from technical indicators. This is not to say that anybody who engaged in technical analysis can make money out of it. Most people are going to lose money because most people don't have access to the tools and the statistical capabilities and knowledge to be able to understand how statistical signal can be correlated with future outcomes in stock movements. It's a very complicated topic. There is a reason why only top funds have managed to make money out of this. It's because it requires a tremendous outlay of capital in infrastructure, data ingestion, data processing, and data modeling to be able to derive any significant results from technical analysis. The random guy looking at charts all day, trying to intuitively and with a very limited cognitively bounded human brain, trying to establish these statistical patterns by looking at graphs and indicators is not going to be able to make money out of this. Most people actually engage in technical analysis from the perspective of trying to predict where the stock is going to go, and that's completely fair. The golden rule is that if you cannot successfully backtest a technical indicator, you shouldn't leverage it for predictive outcomes. That is the golden rule of technical analysis. In other words, if you haven't properly studied the statistical effect that the technical indicator has on future stock patterns, it means that you cannot reasonably be sure that that technical indicator that you're looking at actually works. And you will always find some indicators that you believe are correlated with future stock movements. But you shouldn't engage in doing that activity unless you can rigorously ensure that you can prove that your technical indicator has worked over historical data. And even that activity has some shortcoming, because having a technical indicator working on previous historical periods does not guarantee that that technical indicator is going to keep preserving its predictive power over the next period that they're using it for. And that's where that thing gets tricky, because the technical indicators that are derived from technical analysis are nothing more than statistical embodiment of how the collective herd, the collective mind of investors behave in any specific point of time. And there is a very reasonable case to be made that the human mind has been behaving in a consistent way over a very long period of time. But there's also the introduction of so many new dynamics that did not exist in the past. For instance, high frequency algorithmic trading is something of the present. It means that some technical indicators that could be performing really well in the past would essentially perform really bad under a new regime that introduced new trading dynamics that wasn't present in the past. So trends are, trading regimes are changing, and nothing guarantees that your technical indicator, the one that you've thoroughly backtested over historical periods, keeps working in the future. Now, with all of that said, it's still a pretty fun thing to do. And the reality is that it's just very exciting to get into that topic. Whether you have the humility to realize that you don't have the technical infrastructure to be able to have an actual positive impact on your returns, it's still a fun activity to engage in. So this is what I'm going to show you today. Now, the reality is that there's a bunch of online softwares, online platforms that provide a lot of very rich and useful data very conveniently for you, right? So here, for instance, I like to use this platform to have take a stab at my fundamental analysis and kind of like the narrative storyline building that I do, that I've been talking in the previous episodes of this series. But the problem with that is that you cannot really build any significant fundamental models or technical analysis models with these platforms. At least it doesn't work really well. And if you do want to use platforms or like softwares to run your backtesting and technical analysis, it very often costs you a bit of money. So what I like to do is I like to do it by myself. Grab a good old Python notebook and ingest some data and just take a stab at it by myself. We're not going to dive too much into the functioning of the code here. I want you to see how I think about technical analysis and what are the stuff that I try to do before I start engaging and putting money at stake into something that might easily be technical voodoo that you don't really control at all. So all of the data can be ingested from the Yahoo Finance API, and then essentially, we've been talking about Live Nation, which is a company that I believe it is at a very exciting time right now. It's on the purely fundamental analytics, I believe that it's a very, very good investment. I'm very, very tempted to take a long position into it. From a fundamental narrative point of view, I have a deep issue with the media ecosystem that it has built around its operational activities. If you want to understand that argument, just go back to the previous episodes of this series. But long story short, what you can do here is you can grab and access all of the data that's necessary, the business summary, the all of the income statement, the ownership structure, the major stockholders, and I always like to kind of like use that data to start building kind of like my own understanding of the company, right? For instance, I always like to look at the cash available per share, the book value per share. Here, if I buy a share in Live Nation, I buy it for somewhere around $130, and I get roughly, like $30, so kind of like 25% of it in cash straight away, plus the $2 that I get just in book value. So I get roughly, I get more than 25% roughly in existing value from the company just by investing $1 in that company. Now, there is still narrative around growth, and so there is a reason why I'm paying somewhere close to, like 90 or like 50 forward P ratio. So I'm paying essentially like more than 50 times for earnings. That's a crazy, that's a crazy number. This is very, very likely, this is entirely hinging upon the fact that there is a tremendous amount of growth that's coming up for the company. And the reason why I'm introducing all of this is that that graph that I have here, or that I can have here, I can reproduce it. I can reproduce my candlestick graph straight from my original data. And for those of you who might be seeing this candlestick data for the first time, it just tells me essentially kind of like the opening, the closing, the highest value and the lowest value. So this is a pretty fast and convenient way to see what has been the sentiment for a specific trading day. I can see here, for instance, that there hasn't been there's been quite a bit of volume trading on that last day. The price hasn't budged too much. There has been a bit of a bullish rally to kind of like purchase some stock, but it came down very, very fast. And so the final kind of like price increase over the last day of trading was pretty small, let's say. Now, why do I grab this data? Well, if I'm a technical analyst and I look at this chart, what I might be doing as a technical analyst is saying, well, you know what, Live Nation right now has, long term, if you look at the very, very long term, it has been increasing quite a lot. We've reached a all-time high value of somewhere around $174. Since then, Live Nation just went back to the moving average 90 days and has been on a downward spiral since. So medium term and short term trend have been definitely bearish, with people not very excited by the latest earning call, the one that essentially surprised everybody with a 44% decrease in the price. In the earnings. And that resulted in a pretty massive price decrease, a small correction, but overall a very negative trend that is essentially reflecting a bit the fear that investors are having around Live Nation. This is why Live Nation has been in the oversold range for a few days before picking back up, but overall, just hitting the oversold range by, as displayed by the RSI. And even though overall earnings have had a good profile, so earnings have been increasing quarter over quarter over the last year, it's still lower than the last year earnings, which is a bit of a worrying trend for Live Nation. It's been a bit stagnating, it's missed a lot of milestones, and even though it comes from a good year of strong performance, it's now back on its historical pattern of not hitting its earnings goals. Now, volatility has been quite high. You can see a lot of volume here, a bit of a calming tendency, but overall some very kind of like large price movements, which indicates kind of like a high volatility index for Live Nation. And a bit of a sideways trend where it's not very clear where things are going over the last day. We clearly seems to have hit some kind of support level here at 128. It's not very clear that the stock can kind of like break through again upward of the seemingly 132 resistance level back towards its 90 days moving average. So why am I saying all of this? Because I want to show you that you can introduce any technical terms you want to introduce in the picture, and they're always going to be related to trends and volatility and frequency of purchase. The reality is that these could just be actual practical signals that do correlate with future stock movements, or they could be just the most obvious giant scheme of confirmation bias that anybody has ever used, to do anything. And the only difference between calling this statistical pattern or confirmation bias is whether you can actually find some statistical signal that you can backtest. That is the big difference. That's what's important here. So the reality is that your job as a technical analyst is not to just look at this graph and go on and on about these narratives that you can paint in any direction whatsoever. Your job is to get your hands dirty, grab your data, and start studying the actual practical signal that exists in your data and see if you can actually correlate it with performance. And the way that you would do this is you would essentially just grab, again, your stock history, and you would start building your technical indicators from scratch, right? So for instance, me, what I always like to do is I like to plot my own chart with what I believe are the most important technical indicators that I always refer to. I like to look at Bollinger's bands for volatility. I like to look at MACD for momentum. So I like to have my my go-to technical indicators, the one that I actually understand better than any other indicators. And I like to start building my backtesting on these technical indicators. Now, if you're not familiar with what I'm talking about here, backtesting is just essentially the process of building your counterfactual, your what would have happened if I had done this in the past. I'll give you an example. Imagine that you're a technical analyst who has a very simple rule of thumb. Whenever the last day of trading is up, you start going long on the stock, so you purchase some stocks. Whenever the last day of trading was down, you start selling that stock. In other words, as a technical analyst that follows that specific rule, what you would do here for that day, because the stock went up, is you would go long and purchase more of that stock. If you look at the day before, the day went down, so here you would start shorting the position. You would start shorting Live Nation. Now, this is your very, very simple technical analysis heuristic. This is the one you follow. Is that a profitable strategy over the last year of trading in Live Nation? In other words, what is the backtesting of that strategy? How would that have performed if you had applied over the last year of trading that strategy and purchased when that strategy told you to purchase the stock? Now, this is exactly the purpose of backtesting, and this is exactly why you have this subtle, implicit assumption that a backtested rule is only useful if it keeps repeating in the future, it keeps being valid in the future. Now, how do you backtest these rules? Now, what I would do is something like this. You actually have a library in Python called backtesting, which is pretty useful. You start defining your MACD function and your kind of like simple bullish crossover, for instance, bullish crossover rule, which is that, you know, when your MACD crossover happens, you start buying some stocks, and when the reverse happens, so when the signal goes below the MACD line, you start selling that stock. So how does that, again, a bit more of a complicated rule and heuristic, but very, very similar to what I've just described with the simple heuristic here. So how would that rule have performed if I had applied it to the letter, to the dot, over the last year worth of trading, or even better, over the last 5 years worth of trading? Well, this is exactly what my backtesting exercise is here. So my backtesting exercise basically tell me, look, if you had followed that rule to the dot over the past year or over the past 5 years, here are the periods you would have purchased. So for instance, here I have a MACD crossover technical indicator kicking in, which makes me go into a long position. And guess what? That's fantastic, because the stock actually appreciated over that period that I bought it based on my technical analysis. So you do the collection, you start collecting all of these positions that you take, the long and the short positions that you take based on that technical analysis that you're doing. And you start looking at how wrong or how right your rule would have been, and more critically, how much incremental return you would have generated compared to, say, a very simple buy and hold strategy. So a very simple strategy of saying, you know what, I'm just going to buy my stock when I believe that it's a good stock based on my fundamental analysis and storyline around growth. I'm just going to buy it, I'm going to chill, I'm not going to touch it. And now what you want to do is you want to compare that technical analysis driven trading that you're doing compared to the buy and hold. This is exactly what your backtesting does for you. It tells you that, you know, from the beginning of the investigation to the end of the investigation, so 2020 to 2025, essentially over 1,800 days. The final return that you generate thanks to your backtesting, thanks to your heuristic technical analysis that you came up with, is minus 12%. And this pales in comparison to the 49% of buy and hold return. So essentially, the buy and hold that you would have gotten if you had gone long here at that period of time and you had held that stock up until the end of your kind of like 5 years window, that buy and hold would have kicked the ass of that very, very useless technical rule that you came up with. And now you're going to tell me, but Sean, like, how did you come up with this rule in the first place? Like, why is it that you are essentially basing your trading patterns on MACD or any other technical indicators? That's a very good question. Now, again, this is where science and art are mixing a bit. The science behind it is that there is no science. So the science is that short-term stock movements are just completely random, erratic patterns of statistical noise, and it makes no sense to kind of like try to do this kind of stuff. The art here is that, wait a second, if enough people look at the same data and come up with the same stupid rules and heuristics to guide their price, their stock purchase or sales, then you do have some patterns, some behavior that you can start inferring from that data. And this is what I think is happening essentially in technical analysis. If enough people believe that a kind of like artificial indicator, let's say MACD technical indicator, is a reason why you should buy or sell stocks, then the fact that you are heading towards one of these indicators becoming true or false is the precise reason why you can pick up on that pattern. In other words, if enough people believe something, that thing is going to become true. That's the whole underlying thesis of self-fulfilling prophecies. This is why I believe that there is some merit to the theory that technical analysis can actually work over a short or medium period of times. And this is why it is worth for you to go and start researching your technical indicators, so the technical indicators that already exist, plus some technical indicators you could come up with creatively if you spend enough time in the industry doing your own things. And it is worth backtesting them and see if they have any merit. Now, this is a very dummy example that only really works because we are, demonstrating the concept. In practice, you should really not do this kind of stuff unless you are part of a massive fund, a massive entity that has access to a lot of resources and that definitely don't have to rely on the free Yahoo Finance API to do their technical analysis. In other words, don't do what I'm doing here to do it. Now, while we are on the topic of backtesting and finding statistical patterns in data, I can't close that video without mentioning the overall kind of like relationship between the standard S&P futures and the S&P stock price. Now, this is another